Just talk us through at the moment, moving away from the crypto sphere into good old equities, bonds, and indeed cash instruments. Where are people gravitating as we think about a higher interest rate environment?
Yeah, so, and I don't know that people are necessarily taking money out of crypto and putting it into cash instruments. I think there's a very different risk tolerance there. But we are in a period where you can look at things like the 6-month Treasury yield above 5.2%, a 2-year Treasury yield above 5%, and you're getting a really good yield for parking your money for a pretty short period of time. And I would say, as an investor, even a long-term investor, what you want to look for over the short term, no matter what the instrument is that you're investing in, you want to look for very obvious dislocations in markets. And right now, I do think that this is a time where the Treasury market is seeing a brief period. I don't know that I would call it a dislocation necessarily, but there is a little bit of a disconnect between the Treasury market and the equity market. So this is an opportunity in Treasuries to get a yield that we may not see again for many years.
Liz, thank you for joining us on this International Women's Day. We were just showing the NASDAQ 100 on a 3-day basis, pre, during, and after Powell. And I ask you, where does that leave us as we value tech shares in particular, this kind of reset of how we think about rates, bigger increments and higher for longer, right?
Right. Well, what happened this week is Jerome Powell did it again. His comments moved markets, and he moved them pretty quickly and in a big way and in a lot of different ways. So what we heard from him was we put the possibility back on the table, not even just on the table, but now it's looking to have almost a 70% chance of maybe a 50 basis point hike at the next meeting, which is just a couple weeks away. So what it did for markets is it now has to force us to digest the possibility of maybe not that steady sort of trickle out of hikes that we were expecting. One of the things that I found peculiar about this statement was that the Fed had continued to say, we're not going to repeat the same mistakes of the late 70s, early 80s. We're not going to go through this stop-start cycle. This sort of would be similar to a stop-start cycle. So now markets are forced to digest kind of a jagged rate path, and it's going to be more difficult, both in the bond market and the stock market. The bond market is having a hard time with that, which is why we're seeing a over 100 basis point inversion now between the 2-year and the 10-year yield.
Liz, you're a chart watcher, and I spent all day with Caroline agonizing which chart am I going to show. And in the end, I decided, you know what? I'm just not going to show a chart. I'm just going to ask a question. You're really focused and zeroed in on jobs data. And what we've been talking about in the tech sector is the big headlines around layoffs, but the data doesn't necessarily reflect all of those people being out of work. How are you reading the tech headlines when it comes to layoffs?
Well, I think what happened with the tech headlines is that they hurt sentiment in the short term. But the reality is that tech jobs didn't make up a huge portion of the labor force, and or people that were laid off weren't going to claim unemployment. So we didn't see it in the data. We didn't see it in the headline stuff that we would normally expect to. However, we got some data today. So the JOLTS data, which is job openings and quit rates. The JOLTS data is still strong in the sense that there are a lot of jobs open. There's still a 5 million person gap between the amount of jobs available and the people who are unemployed. So the labor market remains tight, make no mistake. However, there was something under the surface in that JOLTS data. If you look at construction jobs open, that fell month over month by 49%. That is a huge drop. Now, I don't want to rule out the possibility that it was seasonal or that it was just an anomaly because it was January. That could be the case, but that is a very big drop. And the reason you want to watch construction jobs is because they do tend to lead the overall labor market. So if that becomes somewhat of a canary in the coal mine, it's something that we're going to look back on and say, aha, that was where the break started to happen.
Meanwhile, the 2s, 10s, the inversion of a yield curve, has been screaming to many the recession is in the cards for a while. Ultimately, if you're looking at putting money to work in more growth-orientated names, is now the time, Liz?
Straightforward growth names I would probably not buy. If you were going to just paint with a broad brush, I would not do that right now, particularly because we saw such a big rally from the start of the year, and those valuations did get more inflated. Now, regardless of what happens with market direction from here, in any bear market, there still are names that do better than other names. So you could index towards high quality growth names, high cash flow generating growth names. One of the places that you can look for growth is in the healthcare space, and particularly if you move down the market cap spectrum, so into the smaller cap names, they are heavily in biotech and pharma. You're going to get growth opportunity in those names without the rate sensitivity that you would get in classic technology, communications, and consumer discretionary. So if you really want growth in the portfolio, you could look there. It's not top on my list right now of things to buy, mostly because a lot of times when you look at what leads you into a market peak, it's not the same stuff that brings you out of a market trough. So I do expect that there's going to be a rotation and we're going to see different sectors lead on the other side of this.